There we go. We're now recording, and we'll be covering Chapter 9 about the risk material misstatement. And following that, we will cover the homework from Chapter 8, which is the last chapter that we covered 2 weeks ago before the exam. So I realize we're a little bit behind for what's on the syllabus, but that's okay. So here in Chapter 9 about assessing the risk material misstatement, we're going to see various types of risk which come together in the audit, and again, how we control those through evidence gathering. We'll see how we assess those risks. And when it comes to risks which face the auditor, how important do you think this is from the auditor standpoint? Very, very, very important. And how much do they expect to know about risk on the CPA exam? A whole lot. Yes. Fortunately, risk is not going to be difficult for you. So I think you'll do just fine here. And when it comes to assessing the risk material misstatement, we will continue that next week in Chapter 10 as we assess the risk of fraud. So the first thing here, well, in assessing audit risk, in general, some general things we need to know. Well, first of all, auditors are required to obtain an understanding of the entity and its environment, including its internal control, in order to assess the risk of material misstatement in the financials. So how likely is this financial statements to contain a material misstatement in it? Is it high? Is it medium? Is it low? Well, I'll tell you what, the higher the risk of material misstatement, what about the amount of evidence we must gather in the audit, do you think? It gets higher, you bet.
Professor, can you hear me?
Say again, please.
Professor, down here. Can you share your screen?
Oh, I am sorry, yes.
Thank you.
I sure can. Okay, thanks. It's not on the projector either. Okay, let's figure things out here. I'll share my screen here. I apologize for that. And, strange, my computer signals detected. Let me try the other cable here. Okay, now things are coming through. Okay, we'll just try to assess if it's recording okay. Okay, sent me a little message that maybe it isn't too. Okay, I'm going to hope it's recording okay. Well, one thing in B, how many risks in life are really zero? They're not, no. So audit risk can never be zero in practice. And that's why auditors almost always emphasize reasonable and not absolute assurance. We give ourselves some wiggle room. We don't want absolute assurance going off and saying that we give 100% guarantee, because that's just not realistic. Well, auditors have to distinguish between the risk of material misstatement at the overall financial statement level versus at the assertion level. So overall, that's the big picture. So at the overall financial statement level, this refers to the risk which pervade the financial statement as a whole and could affect a number of transactions and accounts, as well as assertions for those accounts. And factors which may affect this risk include deficiencies in management's integrity or competence. That just makes everything go downhill. Higher risk of material misstatement. Same thing with any effective oversight by the board of directors or inadequate accounting systems and records. Declining economic conditions, like in a lot of retailing right now, or significant changes in the client's industry. That spells high risk too. And at the assertion level, this is going to refer to inherent risk and control risk that will be assessed account by account, and we'll study more about these later in the chapter. Well, here are some risk assessment procedures that we'll take, and they won't be too surprising. One thing will be inquiries of management and others in the entity. So what is your assessment of risk? We often ask that of management, for example. Then, analytical procedures. There's another one. So with analytical procedures, if we see sudden changes and they're not good, that can key us in that there's high risk. Observation, inspection, we might see things not going right. Discussion among audit team members, we might brainstorm and think things are not going right. And then other risk assessment procedures. This might include such factors as predecessor or the previous auditor comments, our knowledge obtained from other engagements for the client. Our non-routine transactions are always high risk because they don't fit the overall mold. And other knowledge gleaned about the client. Now, when it comes to fraud, we'll be studying more about that in Chapter 10, the next one. But the auditor is going to very carefully consider fraud risk because misstatements arising from fraud will be more difficult to detect than misstatements arising from errors in general. As we know, fraud often involves intentional concealment. This concealment can be very sophisticated. And the auditor will also be very interested in how management goes about its own assessment of the risk of fraud. The auditor is going to assess fraud risk at both the overall financial statement level and at the assertion level. So overall, pervading the financials and at the level of individual transactions too. Well, risk and materiality are closely related. And risk is a measure of uncertainty, and materiality is a measure of magnitude or size. So risk, what are the odds? What is the probability? Materiality, that's how much in the way of dollars that we're going to tolerate and still say things are okay. But together, they measure the uncertainty of amounts of a given magnitude. Now, we'll turn our attention here to identification of significant risks. Let me just see something for a second. So this assessment or identification of significant risks, what stands out to us is normally risky things. Well, first of all, what is significant risk? We see that in A. A significant risk represents an identified and assessed risk of material misstatement. That in the auditor's professional judgment requires special audit consideration. So something is really, really risky here. There could be something quite messed up about the client's financials. And we'll see in later chapters, the auditor must obtain an understanding of internal control relevant to the significant risks in order to evaluate the design and implementation of related controls. And the auditor must also perform substantive tests related to the assertions which are deemed to have significant risk attached to them. So we're trying to find out whether or not there are truly misstatements. And significant risks often relate to the following: non-routine transactions. The client is not used to making them on a day-to-day basis. They may mess them up, if they even make them. A good idea of this would be an adjusting entry. There's no movement of cash or of any other asset to prompt the client to make the adjusting entry. It's just that time of the year. So clients often mess them up. They don't do them every day. They're just not too familiar with them. And then number 2, matters which require significant judgment. So like that valuation of the inventory of antiques. Well, in that case, we just don't know, as an auditor, what we think the value might be. And fraud risk. So again, more about that in the next chapter, chapter 10. Well, now the audit risk model. So the audit risk model is going to be something we'll be quite familiar with, and I'll guide you through it here. But the audit risk model is a planning model to decide how much evidence to gather. It's not subject to precise calculation. So we're never in fact going to have overly precise numbers or probabilities for how much risk we have in life. I mean, how many risks in life can we really measure down to the percentage point? Very, 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 very few, if any. Same thing in audit. Well, the amount of evidence to gather is always a judgment call, of course. So the audit risk model gives the auditor a framework to justify and defend this decision. So it's always up to the auditor's professional judgment as to what risk is and how much evidence to gather. So as with other things in auditing, the auditor's professional judgment is going to be the correct answer on the CPA exam. And the auditor is going to assess the following risks, and we'll study them in a second: acceptable audit risk, inherent risk, and control risk, which are the independent variables that we will see in the model, to arrive at plan detection risk, PDR, which is the dependent variable. In other words, it's dependent upon values of the other variables in the model. So let me go ahead and write that up here on the board here for you. I'm going to be stopping my share here for a moment, for those of you online. And let me go ahead and come back and get myself on screen. There we go. And okay. I hope this marker does pretty well. It does. Good. So we'll be taking a look at that audit risk model quite a bit. And again, these variables in it. So plan detection risk equals acceptable audit risk divided by the product of inherent risk and control risk. I will then be looking at each of these risks and the relationship to the amount of evidence to gather. So relationship to evidence, or in full, the relationship to the amount of evidence to gather. look at PDR, inherent risk, control risk, and acceptable at risk. I'll be coming back to this on the board too. Does everybody online have a copy down? Okay. If not, don't worry, I will be back. Thanks, Stacy. So I'm going to go back, sharing my screen. So let's define B, plan detection risk. So here is the dependent variable in the model, or in other words, it's dependent upon those independent variables we have. So plan detection risk, PDR. It's the risk that audit evidence will not detect a material misstatement given that the misstatement exists. So there's a misstatement out there, and assume it's material. Well, what's the risk that we will not detect it? We can never say zero. So PDR is inversely related to the amount of evidence to gather. Thus, more evidence gathered will lower plan detection risk because we look at more evidence, we're more likely to catch that error, that material misstatement. If we look at less evidence, we are less likely to detect that material misstatement. And since PDR is a dependent variable, its value is dependent upon the independent variables of the model. And I have a little note there, it's like type 1 error for a material misstatement, thinking back to statistics. Type 1 error is the error risk where we don't detect something is wrong from our sample. If we've been able to examine the entire population, we would have seen something is wrong, but our sample just didn't catch it. It's no one's fault. That's just an inherent risk of sampling. But obviously, the bigger our sample is, the more likely we are to find something that's wrong in the population. Same thing with PDR. So the greater the evidence gathered, the lower plan detection risk is going to be. Plan detection risk, again, being the risk that we don't detect that material misstatement. So when it comes to PDR, going to stop sharing here for a moment, we can say that plan detection risk has an inverse relationship to evidence. So again, we gather more evidence, plan detection risk goes down, because there's less of a chance that that material error slips by us. Inversely, if we gather less evidence, plan detection risk goes up, because there's more of an error, more of a risk rather, that we do not detect that material misstatement. That makes sense? All righty. Let me just see something. Lisa Clark sent me an email a little bit ago, right before class. I just want to see if she has been able. Pardon? Oh, I'm sorry. Okay. Well, everything worked out. Sorry, I was driving at the time the email came in. Okay. I'm going to go ahead and share my screen again. Then C. If we go down to the denominator, well, one independent variable that we see is inherent risk, IR. It's the auditor's estimate. The material error exists in an account, assuming no internal control. That may sound strange, but the reason is because internal control is considered separately under control risk in a moment. And inherent risk is usually high for accounts which are very liquid because they can be stolen like cash, have many transactions. Each transaction is a potential misstatement. Or they're larger in dollar size. It also depends on some factors in our book, which we'll see in a moment. Before we do, actually, let me go to the book here first. I'll flash it up here on my screen. As soon as I find it. $276, whoops, made a transposition error. I put 267, there, easy to do. Here we go, some factors affecting inherent risk. So here are some things like nature of the client's business. So if we have a client in brick and mortar retailing right now, they're mostly in malls. What would you say about inherent risk of just about every single one of their accounts? High. Yeah, just like damaged and obsolete inventory. In fact, inherent risk is assessed account by account and can vary a lot from one account to another. Well, then the next two kind of go together. Results of previous audits and initial versus repeat engagement. In previous audits, we probably know about the risk of material misstatement already. But if this is an initial audit engagement, well, we don't have that luxury of knowledge. In fact, we're probably going to assume that inherent risk is high. Play it safe. Then related parties. A related party transaction, what would you say about inherent risk of it? High, very high. They've been involved in almost every fraud that's happened. A complex transaction or a non-routine transaction, high, can be messed up. Clients are not familiar with them. Again, adjusting entries often fall in line there. Do accounting students mess those up too? Yes, they do. Then judgments required to correctly record account balances and transactions. Well, that side too. We like things which are non-subjective. Make up the population. And your book uses this. If we have accounts receivable with a bunch of past due receivables, that spells high inherent risk. Then factors related to fraudulent financial reporting, again in the next chapter. If fraud is likely, in this case accounting fraud, misstating the financial statements, that means high inherent risk. And then factors related to misappropriation of assets or stealing assets. If it's likely assets could be stolen, which is employee fraud because the lower level employees have the motivation to do that, well, that means high inherent risk too. So coming back here to my handout, I've got there at the end in this little note, high inherent risk, cash. In fact, I can guarantee the cash is 100% inherent risk. Because if there's no internal control over cash, how likely is it the cash will be misstated? 100%, yes. Someone will steal some. Accounts receivable, inventory, again, can steal that. Adjusting journal entries. Low, most property, plant, and equipment, especially land. That's the lowest inherent risk of all usually. Capital stock, that's low. Especially old issue, because we only did that last year or even before. We already know how much is there. So when it comes to an account with high inherent risk, how much evidence do you think you want to gather? A lot. So cash, we gather a lot of evidence. Something like land, we don't gather much evidence at all. So let me go ahead and come back here to my board and fill that in. When it comes to inherent risk, relationship to evidence is a direct link. By the way, it will be with the other thing in the denominator too, control risk. Let me write that up here while I'm at. So with inherent risk, the higher the inherent risk, the more evidence we must gather directly. The lower the inherent risk, the less evidence we're going to have to gather. So a direct relationship there. And I will go back sharing my screen. So that brings us down to D. D with control risk. Let's see why that is. So this is a risk that internal control will not prevent and or detect material misstatement. We don't want that to be very big. So if internal control is working, control risk goes down. That's a good thing. If internal control is not working, control risk goes up. Could be a maximum 100% if internal control is totally not working. So that's why I say in this next sentence, if in doubt, set control risk at 100%. And in fact, if control risk is set below 100%, the auditor must document why by evaluating internal control and conducting test controls. We'll see that 2 chapters down the road. I have a little note there that we can note that poor management integrity can affect control risk. It's going to make it high, as management will be less likely to institute and enforce good internal control and will be more likely to override internal control. Not good. Now, in E, if we think about this, we can note that the denominator of the model, which is inherent risk times control risk, is the expectation of misstatements in a particular account after considering internal control. And we've also noted that both inherent risk and control risk are both inversely related to plan detection risk and are therefore directly related to the amount of evidence to gather. So thus, and again, based on what I wrote up on the board, if either inherent risk or control risk is higher, the auditor is going to gather more evidence. If they're lower, gather less evidence. So, a couple little notes here. First of all, both inherent risk and control risk can vary much from one account to another. So we assess them account by account. And then number 2, for accounts with high inherent risks, such as cash and merchandise inventory, it's a good idea to have low control risk through good internal control. We protect them that way. Now, conversely, internal control may not be as stringent over accounts with low inherent risk, such as land. Land, what you do to it, I guess, fence it in. You hope a sinkhole doesn't open up, which is a real possibility here in Central Florida. We can explain both these ideas by the product of inherent risk and control risk. So therefore, we would like for this denominator to be as low as possible. Let me go ahead and stop my share there for a moment. In fact, if I take these two, inherent risk and control risk, actually, whoops, when we were talking a little bit ago about the risk of material misstatement, that denominator. And there again is a direct relationship to the amount of evidence to gather. So here's the expectation of a material misstatement in an account. The risk material misstatement is inherent risk times control risk. Direct relationship to evidence to gather. Certainly an account with high inherent risk like cash, we want really, really low control risk. That gives us low risk material misstatement. And then we can reduce the amount of audit evidence we must gather. So we want this RMM to be as low as possible. An account that already has low inherent risk like land, we don't have to have a lot of control risk. We don't have to have a lot of internal control over it because inherent risk is already so small. So we would not spend much money on control and on internal control over land. It's just not worth it. Over cash, it is worth controlling it. It is worth spending resources on internal control over cash because in the end, that's going to save you money in more ways than one. So any questions so far? All righty. Share my screen again. Well, then F, acceptable audit risk, AAR. That's what's in the numerator of the audit risk model. It's the subjectively determined risk the auditor is willing to assume. So it's very subjective, set by the auditor, that the financial statements are not fairly stated in all material respects and the clean opinion was issued. Thus, it's analogous to type 1 error for the audit opinion. And we can know it can never be zero because the auditor cannot guarantee freedom from misstatement. So like any other risk in life, zero is not possible. We can also note that acceptable audit risk is directly related to plan detection risk and therefore inversely related to the amount of evidence to gather. Thus, if the auditor is willing to accept a higher acceptable audit risk, gather less evidence because we might not catch what's wrong. But if we want a lower acceptable audit risk, gather more evidence, more likely in that case to catch what is wrong. Now, acceptable audit risk does not vary from one account to another because it relates to the opinion issued. So it's overall. And the auditor is going to be stating his or her assessment of acceptable audit risk for the audit in the working papers as a part of planning documentation. And sometimes acceptable audit risk is called audit assurance, just to let you know in case that term comes up. I don't like that term as well. I like hearing risk. Let me stop my share for a moment. Go ahead and complete this little listing back here of risk and evidence with acceptable audit risk. Again, bearing in mind, there's an inverse relationship to the amount of evidence gathered. There we go. Completed the chart. Everybody online got everything on the board. Okay. Share my screen. Now, here in D, something called engagement risk. It's another risk concept, but it does not appear in the audit risk model. Well, here's what it means. Engagement risk is the risk the auditor will suffer harm as a result of the audit, even though the audit report was appropriate. So what is that? Well, engagement risk partly depends on how likely the client is to fail after the audit. If the client goes under, maybe someone is looking to get money, and maybe that person is trying to get money from the auditor. Good example of engagement risk. It's also based on the extent to which users rely on the financials for information. Thus, greater engagement risk is indicated by publicly held versus privately held client. Publicly held, the SEC is involved, plus there are a lot of potential plaintiffs and we have a lot of stockholders. Public information. Poor versus good financial health, just like in retailing right now. Large versus small client. More potential plaintiffs with the large one. More money's involved too. Greater amounts of debt and equity securities. Those spelled, could be more money lost. By the way, poor management integrity also indicates greater engagement risk. Engagement risk may be factored in the model by lowering acceptable audit risk. So with high engagement risk, we want to lower acceptable audit risk. We do not want much of a chance of issuing the wrong opinion. Also, audits with high engagement risk, as well as high risk material misstatement, may require more experienced audit staff, or may be reviewed more carefully. So it means they're more expensive in the end because we're playing it safe. And then H, relative risk is another term that you'll sometimes see. An account has greater relative risk than another account if it's larger, more material, has higher inherent risk or higher control risk. That's all it means. It's an older term. Thus, more evidence usually gathered for accounts with high relative risk because they're just relatively more risky, and that's why. So that didn't take very long. That is Chapter 9. Questions there about Chapter 9. So like I said, we'll be doing the Chapter H homework. Should I go ahead and get into Chapter 10 tonight? I think we should too. Want everybody online to vote? Okay, I'm not getting much feedback. All right, we'll go ahead and save Chapter 10. Okay. Shoot. Yeah, I'm in the mood. I mean, I could just roll all the way through Chapter 10. Maybe get in Chapter 11 night too. I'm the only one that's been energized by the mini spring break today. Yeah, it seems strange that we did not get a spring break this year. But of course, we bear in mind that last year here at Florida Southern, all student travel was canceled the evening before us to go out over spring break because of COVID. Yeah, so no spring break this year. Do you think we may get a spring break next year? I think that we may. Let me stop my share. I'm sorry. Yeah, I think that we may as well. So I think things are looking up. Has anybody been vaccinated yet? No, me neither. So hopefully we will be soon. All right. Well, the other thing that I have on tap for tonight is going to be going over the Chapter 9 homework. I just need to run upstairs to my office to get my book. So take about a 3-minute break or so there, and I'll be right back. All righty, I will go ahead and share my screen here and we'll take a look at the problems in the book. So the first thing that we had, as always, are some review questions at the start. Did you have any questions on any of the review questions? Are those okay? Okay, good. Usually they're pretty basic. So let's look at multiple choice questions, multiple CPA exams. First one's number 25. So the following questions concern the planning of the engagement. As always, select the best response. And the first one is, which of the following will most likely indicate the existence of related parties? Which one would you say? 4. Borrowing money at a rate significantly below the market rate, that is a very common type of related party transaction. So lending money to someone in top management at a really low rate, that just does not match fair market value. So that's the problem. Then B, which of the following is least likely to be included in the lender's engagement letter, which we saw a couple of weeks ago? What would you say? It's number 1, details about the preliminary audit strategy. We would like not to disclose that because we want to surprise the client. If we disclose to them what we're going to do, they're probably going to go in there and clean things up. We don't want that. Then C. Analytical procedures used in planning an audit should focus on identifying, what did you say? 4. Areas that may represent specific risks relevant to the audit. Then we've got number 26, pertaining to client acceptance. So when approached to perform an audit for the first time, CPA should make inquiries to the predecessor or previous auditor. This is a necessary procedure because the predecessor may be able to provide the successor with information that will assist the successor determining whether, what did you say? 4. Very good. Whether the engagement should be accepted. We don't want to accept the engagement if it's a high-risk client or one that's otherwise going to be high maintenance or anything like that. Then B, a successor would most likely make specific inquiries to the predecessor auditor regarding, what might you say? 4, very good. Disagreements with management as to auditing procedures. Sounds like management might have something to hide. At the very least, they're just difficult to get along with. And do you think we want a client like that? Nah, let's bypass them. Then C, which of the following circumstances would be most likely to pose the greatest risk in accepting a new audit engagement? 2, there will be a client imposed scope limitation. We sure don't want that client. They're covering something up. Then number 27, dealing with materiality. So first, which one of the following statements is correct concerning the concept of materiality? Oh, it's a familiar one. It's on the CPA exam a whole lot. It's almost too obvious to be true. It is number 4. Very good. Materiality is a matter of professional judgment. You know, something like that that sounds so obvious, so easy. Oh, that surely can't be the one. It's got to be a more involved, more complicated answer, right? It's not. Then B, in considering materiality for planning purposes, an auditor believes that misstatements aggregating $10,000 will have a material effect on an entity's income statement, that misstatements would have to aggregate $20,000 to materially affect the balance sheet. Ordinarily, it's appropriate to design audit procedures are expected to detect misstatements that aggregate. Which one would you say? 1, very good. If in doubt, err on the conservative side. Go for the smallest one. In this case, 10,000, number 1. Then C, a client decides not to record an auditor's proposed adjustments that collectively are not material. It wants the auditor to issue the report based on the unadjusted numbers. That's actually okay. Which of the following statements is correct concerning the financial statement presentation? And what would you say? 1, the financial statements are free from material misstatement and no disclosures required in the notes of financial statements. That's true. So any adjustments or proposed adjustments in this case, the auditor found some misstatements. They're saying, well, these misstatements are immaterial. The client does not need to record them before the client gets a clean opinion. So the auditor must say they're immaterial. The client must also say they're immaterial. For example, on the audit committee here at Florida Southern, we always go through the unadjusted misstatements. We agree as an audit committee that they are not material. However, we do make those adjustments. We can wait until the auditor is gone. The auditor encourages us to do so because next year these might become bigger. And the auditor also encourages us to find the root cause of each one of those. Because again, next year we might not luck out. These might snowball and become bigger. So I don't agree with this client not recording. That's not good. Questions on any of the multiple choice? Okay. We have one problem here over on page 250, and that is number 31. So we've got here some minutes of 2 board of director meetings. Minutes, a little summary of what they talk about. So we're in there doing the audit. Let's just skim through. We've got the meeting of March 5th, 2016, and the meeting of October 21st, 2016. Let's see what the requirements are before we go back and wade through these. First of all, how to use the auditor. Know that all minutes have been made available to you. Well, here's what happens in every meeting under Robert's Rules of Order. I'll show you here. Go back. The board approved the minutes from the previous meeting. It's always dated, so we know that we have them. We can easily track. Then B, we'll read the minutes of meetings of March 5th and October 21st. We'll use the following format to list and explain information that's relevant to the 2016 audit. Obviously, both meetings took place during that time. So we'll see information relevant to the 2016 audit and what we should do as an auditor. And then we'll handle C at the same time. We'll read the minutes of the meeting of March 5th, 2016. Did any of the information pertain to the December 31st, 2015 audit? We'll find some that did. Explain what the auditor should have done during the December 31st, 2015 audit with respect to the 2016 minutes. Ideally, they extended field work until after March 5th so they could read these minutes and see if anything pertained to the 2015 audit. So that's why I always emphasize that we can never finish an audit by fiscal year end. The audit report date is always sometime after. So we'll handle B and C in one fell swoop. So as we go through these minutes, we'll find big picture items that are discussed. As an auditor, we want to make sure that they've been properly recorded in the financial statements and footnotes, etc. So let's look here at the meeting of March 5th, 2016. So just held 5 days ago. Well, the meeting of the board of directors of Tectonic Metals was called to order by James Cook, the chairman of the board, at 8:30 a.m. Do you think everybody was awake for this meeting then? No, we'll probably try and keep from dozing off. Following directors were in attendance. We see James Cook here too. But it's important that we have this list of directors. They should be mentioned in the financial statements. And also, each of these is a related party. So we'll keep an eye out for transactions pertaining to them. We hope those transactions are carried out at fair market value. In certain industries like banking, that is a very big compliance aspect because you sure don't want people coming in and getting loans below fair market value as far as interest rate goes, for example. How bad of a public relations scandal could that be for the bank? Oh, it could be big, yeah. Plus, violates state regulations and federal regulations too. It's bad. Banks are supposed to be a place where we place lots and lots of trust. Then the board approved the minutes from the November 22nd, 2015 meeting. That is relevant to the 2015 audit. We will trace back and make sure that we have them. So 2015 audit, trace back, make sure that you do in fact have them. Then, the board reviewed the financial statements of the most recent fiscal year that ended December 31st, 2015. Due to strong operating results, okay, this company's doing well, the board declared an increase in the annual dividend to the common stockholders from 32 cents to 36 cents per share payable on May 10th, 2016 to shareholders on record at April 25th, 2016. Okay, We want to make sure this is recorded properly. It is not relevant to the 2015 audit, but it is to the 2016 audit. Make sure this is recorded properly. So on on April 25th, you're going to make sure that you have debited retained earnings and credited dividends payable for the correct amount. On May 10th, we'll make sure the company debited dividends payable and credited cash for the correct amount. Then Tony Williams, CEO. He's mentioned up above, otherwise he would have been a new related party. Led a discussion of the 7 core strategic initiatives of the 2016 through 2018 strategic plan. The most immediate initiative is the expansion of tectonic operations in the Pacific Northwest. The board approved an increased budget for 2016 administrative expenses of $1 million to open the offices in the Portland, Oregon area. So we want to make sure that this has been recorded. So spending this $1 million, and we'll expect some other things to be recorded too, like some furniture, some computers. I don't know if they purchased any property, probably not. Rent expense. So make sure the client properly recorded. Then Mr. Williams also led a discussion of a proposed acquisition or purchase of one of Tectonic's smaller competitors. And the board discussed synergies that might be possible if the operations of the acquired company could be successfully integrated with the operations of Tectonic. Okay. Well, the board granted Williams and his management team approval to continue negotiations with the other company's board and management. Well, I guess just make a little audit note. We're going to expect a possible acquisition of another company, but nothing for the books yet. Then the board continued its discussion for prior meetings about the October 2015 report from the Environmental Protection Agency, the EPA, regarding dust impact at Tectonic's zinc refineries. So maybe they're not gathering the dust as they should and filtering it out. The filtration system isn't too good. That's my guess. It's not something you want to breathe. So legal counsel for Tectonic updated the board on the status of negotiations with the EPA regarding findings contained in the report. The board asked management to include an update on the status of any resolutions for its next meeting. The board also asked management to schedule a conference call if necessary to the board if issues need to be resolved before the next meeting. So I would say just make a planning note here on the audit. We could see some effects from this, like maybe an EPA fine even. But let's just stay on top of it as an auditor because that is a significant risk. Then officer bonuses for the year ended December 31st, 2015 were approved for payment on April 14th, 2016 as follows. Okay, Tony Williams, Mary Beth Kate, Bob Browning. Let's just see what those all mentioned up here. I think they were. See, Bob Browning. Okay, we have one new related party, and that is Bob Brown. Bob Brown, CFO. Well, this is relevant to both years. In December 31st, 2015, the company needs to record the bonuses. I'm sorry, go ahead, please. Somebody online have a question? Okay. December 31st, 2015, the client must record these by debiting bonus expense or something like that and crediting bonuses payable. So they must be accrued in 2015 because they were earned for that year. Then in 2016, the company needs to record payment of these. So debit bonuses payable, credit cash on April 14th, 2016. So again, relevant to both years of the audit. And then the audit committee and compensation committee provide an update of the issues discussed in each of their previous meetings. And so that's good. We'd like a copy of that too. Being adjourned at 5:30 p.m. Wow, 8:30 to 5:30. Think these are very awake people at this time? No. They're probably waiting for happy hour. So any questions so far? Okay. So now we come down to October 21st, 2016. Well, for these minutes, obviously the 2015 audit is long gone. So these will be relevant to the 2016 audit. And a good idea to do would be to make some planning notes for the 2017 audit. Just looking ahead at things. Wasn't required, but just a good idea. We look at the slate of directors here, all the same ones, no new related parties. Again, the board approved the minutes of the March 5th, 2016 meeting. So we trace back and sure enough, we have them. Good. Well, then Tony Williams, CEO, provided an overview of financial performance and operating results for the 9 months ended September 30th, 2016. Given the volatility of the economy, Tectonic sales have fallen by over 8% compared with the same period in 2015. To address the drop in revenue, Tectonic has scaled back buying operations by a similar percentage to reduce labor and shipping costs. We would expect all these things to be reflected in the financial statements. We'll expect them all as well as we do analytical procedures. So things look bright before, but now, not so good. Then Bob Browning, CFO, updated the board on discussions with banks that will be financing the acquisition or purchase of the Tectonic competitor. So, okay, good, that went through. The terms of the $7 million financing will include a floating interest rate that is 2% above prime over the 10-year life of the loan. Payments will be made quarterly, and Tectonic will have to maintain compliance with certain loan covenant restrictions that are tied to its financial performance. The board approved the acquisition related loan transaction and scheduled a closing date for the financing to be November 1st, 2016. So as an auditor, let's expect all these things. We'll see this new company coming on board. We'll see the loan and the interest expense. We should get a copy of that loan agreement, the permanent file. Copy of the loan agreement for the permanent file. Every year, we must make sure they are in compliance with any debt covenants, any loan restrictions. They say covenant restrictions, same thing, whatever they may be. We need a copy of that loan contract to make sure. Then we see, to prepare for the proposed acquisition, the board approved an increase in the capital expenditures budget of $1.5 million to cover costs of expanding computer operations, including new servers. The new equipment is needed to successfully integrate IT operations with Tectonic and the acquired company. The equipment will be installed December 2016. Existing equipment that was purchased in 2014 will no longer be used in the IT operations of Tectonic. So, what we expect the new equipment to arrive on the books. So let's record this purchase properly. And the disposal of the old equipment, we expect that to be recorded properly too. So we'll definitely audit both the purchase or acquisition and the disposal. So audit the new equipment, audit the old equipment too. Then next we see that the board discussed creation of an incentive stock option plan for senior executives as a way to better align management and shareholder incentives. So try and get goal congruence here. Consultants from a compensation advisory firm and tax attorneys from a national accounting firm led a discussion of the components of the proposed plan, including discussion of the related tax implications. The board asked the consultants to revise the plan based on comments received at the meeting for presentation at the board's next meeting. So as an auditor, that is not relevant to us in 2016. Make a little note, it will be relevant to the 2017 audit. So we want to follow up and see what happened in 2017 when they actually adopt this. Then Tectonic's external auditor, that's us, provided an update of its interim work related to the test of the operating effectiveness of internal controls over financial reporting. And the audit partner presented a written report that provided information about 3 deficiencies in internal control considered to be significant by the auditor. So good, we did our work there. We'll see this report as we cover chapter 10. I'm sorry, chapter 11. So in this report, we discuss significant deficiencies in internal control. And we make sure the client understands them. We make sure the client needs to take corrective action. So we'll follow up and make sure they have taken corrective action. Otherwise, this is going to be a red flag about internal control. It's going to make control risk higher. So let's hope they fix them. Then here's that EPA problem again. Legal counsel for Tectonic updated the board on final resolution of the EPA report findings. The final statement requires Tectonic to modify some of the air handling equipment at zinc refineries, which is expected to cost about $400,000. Thankfully, no other penalties were imposed by the EPA. And the audit committee and the compensation committee provide an update of issues discussed each of the respective meetings. So let's get that update. And by the way, back to the air handling equipment, we will expect the $400,000 to be booked as an expense. And that takes care of that problem. That takes care of everything from chapter 8 and from chapter 9. We'll be going over the chapter 9 homework, of course, next week. Do you have any questions?
Yes, so on the 16th is chapters 8 and 9 homework and quiz they're due.
Sorry, what's the last part?
Chapters 8 and 9 quiz and homework are due the 16th?
I would need to go back and look.
Okay.
And I will double check my accounting lab. Let's just look here at the syllabus while we're at it. I may not have gotten that far in my thinking earlier. So chapter 9 on the revised syllabus I'd sent out. Right, so I should go back to the other chapters, chapter 8 and everything before it. Those I extended, they're now due on the 16th.
Okay.
And chapter 9 is due the 25th.
Okay, so it's just chapters 8 homework and quiz that's due the 16th.
Yes. Plus, if
Okay.
you want to work on anything from earlier, you can do so until the 16th.
Okay.
Like it
All right,
just
because
goes
yeah, I
by.
looked in both 8 and 9 were on the 16th, so I just wanted to clarify.
Not a problem.
Okay, so just chapter 8 quiz and
Mhm.
homework for 16th. The 16th.
And
Okay.
actually, let me share the screen with you just for a second so you'll see where I just read from. Yeah, this revised syllabus I sent you. Did you get a copy of it?
Probably.
Okay, if not, it's also on Canvas, and if you can't find it, just send an email to me. I'll get that to you.
Okay. Okay. Thank you.
You're welcome. Yeah, I agree, Stacy. I just saw your message there in chat. Yeah, I'm in the mood for chapter 10 as well. Yeah, me too. I know. Okay. Well, we'll cover it next week. Here's why. Because I decided that, well, I know it's the mini spring break today, at least for day students, but evening students deserve a mini spring break too. So we'll get out here a little bit early tonight, and that'll be your mini spring break. Will that help propel you through the rest of the semester? It will. Me too. Yeah, spring break is always a nice way to mark half the semester. I really like how they do it here at Florida Southern. It's the only school I've ever had fall break at. So fall break marks halfway in fall semester. Spring break marks halfway in spring semester. So, well, no fall break this year and only a mini spring break, but we'll make the best of it. So go home, get some rest, enjoy doing whatever you would like. And other than that, I will see you next week. All right. Have a good one. Bye-bye. Bye-bye, everybody online.